Hey there, AP macroeconomics students. I'm Gustavo Rodriguez, and today we'll be going over a few FRQ questions, and we're going to take a closer look to Unit 4 key concepts. Contractionary policy. Contractionary policy is used by the government during inflation to reduce the AD and therefore reducing the GDP. Expansionary policy is used by the government during a recession to increase the AD, therefore increasing the GDP. Reserve requirement is the percent required by the Fed for the commercial banks to keep in the vault for depositors to be able to access their money. Excess reserves is the source of the new loans. To find the excess reserves, you need to get the checkable deposits subtracted by multiplied by the reserve requirement, then get that amount and subtract it from the original checkable deposits, and that's how you're going to be able to get the excess reserves. Now, what is checkable deposits? Checkable deposits is the cash that that depositors put into banks. Basically, that's what it is. Now, money supply is the total amount of money in an economy. Now, fiscal and monetary policy. These two policies are used to influence a nation's economic activity. Fiscal policy deals with Congress and the president, and it basically deals for decreasing or increasing taxes, or increasing and decreasing the government spending. Monetary policy, on the other hand, deals with the Fed, and it controls the money supply. To control the money supply, they use four tools, which is the open market operations, the federal fund rate, the discount rate, and the reserve requirement. Now, the federal fund rate, don't be confused by that. It basically means that the interest rate that commercial banks charge each other over overnight loans. It's not the Fed, just keep that in mind. It deals with the commercial banks. Now we're going to go over the FRQs, and the first one says, assume that a bank receives a cash deposit of $9,000 from a customer. What is the immediate impact of this transaction on the money supply? Explain. I'll give you a little bit so you can answer it. Pause it if you need more time. Okay. You got it? Alright, hopefully you got it right. Now the answer to this is none. Why is that? Well, if we check over here, go back, and it says that this deposit was deposited from a customer. Therefore, the money that he deposited was already in circulation and didn't add no more money or decrease in the money supply, because no loans have been made yet. Okay? Awesome. Let's go over the next one. It says, suppose that the reserve requirement is 10% and banks voluntarily keep an additional 10% in reserves. Calculate each of the following. The maximum amount by which this bank will increase its loans from the transaction in Part A, and the amount increased in the money supply that will be generated from the transaction in Part A. I'll give you a couple of seconds. If you need more time, make sure to pause the video. Okay, you got it? Awesome. Let's go over it. Hopefully you got it right. So to find the maximum amount that this bank will increase its loans, we need to go back to the problem and check how much percent was kept in the reserves. So we get the 10% that is required, and the other 10% that they kept, even though they didn't have to. That 10 and 10% will equal 20%. We get this 20%, and we go back to problem A to see how much was deposited. So it's 900. So we get this 900 and multiply by the percent. 9,000, my bad. So it's going to be 9,000 times 20%. And that will give us 1,800. Now that we have the 1,800, we need to find the excess reserves. To do that, remember at the beginning how I talked about after you found the reserve requirement, you need to subtract it by the checkable deposits. So we get 9,000 subtracted by 1,800, and it will give us there we go, 7,200. Hopefully you got that right. Now in the second one, when it asks about the maximum increase that the money supply will be increased by from the transaction. So now that we know how much is in the excess reserves, we're gonna multiply that times the money multiplier. To find the money multiplier, you need to get the reserve percent and put it over 1. So this is gonna equals 5. We get the 5 and we multiply it by the 7,200, giving us a total of 36,000. Okay, hopefully you got that right. Now moving on to the next problem. It says, assume that the government increases spending by $9,000, which is financed by a sale of bonds in the central bank. Indicate what will happen to the money supply. Explain what will happen to the money demand. If you need more time, just pause the video and I'll go over it. Okay, hopefully you got this right. Let's go over it. So for the first one, we're asked, what will happen to the money supply? Well, the answer is no change. Why is this? Well, if we go back to the problem, it talks about spending right here. And remember at the beginning when I talked about fiscal and monetary policy, monetary policy is what deals with money supply. And fiscal policy deals with taxes and spending. Therefore, this one is fiscal policy and we'll have no change in the money supply. Now the second one, when it says explain what will happen to the money demand, the answer is it will rise. Why is this? Well, if there's a government increase in spending, that means that there's going to be an increase in the disposable income, therefore increasing the GDP in that nation and increasing the money demand as well. So make sure you got this down. Don't forget about the key concepts. Go over them to make sure you know them. It'll be very, very crucial in the future. Well, I'm Gustavo Rodriguez. Until next time.